Believe it or not, folks, the S&P 500 is officially in a bull market. After 18 months of gruesome pain, sell-offs, panics, interest rates, and crypto collapses, the S&P 500's 2022 bear market is finally over. Whether or not your portfolio reflects this is a different concern, but the fact is that the S&P 500 has climbed above 20% of its October 2022 low, which means it is right now in line with what the Nasdaq did just a few months ago and entered a fresh new bull market. Now, in the midst of an upcoming recession, this certainly seems very much odd. Well, folks, as I'm about to show you in this video, the S&P 500 is most likely not going to sell off even if we see a recession. In this video, I want to show you guys the data that shows us how markets typically perform every single time we have seen the start of such a bull market. And we're also going to have a look at why the returns for investors in this recession are not going to be as bad as many people expect. But as usual, folks, before we get into it, make sure to drop me a thumbs up, hit the subscribe button if you haven't already. So, to start things off, folks, let's understand the technicals of where we are today and what makes this a bull market, unlike what many people had expected. On the right here, we have the S&P 500 on a weekly time frame. And as you can see from top to bottom with the 2022 bear market, we saw roughly a 22.5% drawdown, depending on if you count the closes of the days or not. Since we hit that 200-week moving average, the pricing has bounced considerably to almost breach the highs that we saw in August of 2022. We're now above both that purple 50-week moving average and that 200-week moving average in yellow, which is signaling an uptrend in the making. However, the S&P 500 does not tell us the entire story. If you look at the left, here we have the iShares Russell 2000 ETF, which tracks the 2,000 smallest companies with a market cap of under $10 billion. And as you can see, on the exact same time frame as the S&P 500, this index on the left has performed much poorly. It is actually down over the past 1 year instead of nearly being up like the S&P 500. And as you can see, the moving averages are nowhere near below the price action, and neither are they pointing towards the upside. And this right here, folks, happens to be just one of the handful of reasons why many retail investors are skeptical of this current bull market. Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia, the top 10 biggest companies on planet Earth, have been leading the charge with a return of 53% so far in 2023. Whereas the S&P 500 itself is up only 11%. And if you solely look at the 493 remaining companies, your return comes down to a bonkering 0% for the year. And as you can see, as compared to the equal weight version of the S&P 500, the market today has outpaced itself faster and quicker than it has ever before in the past 32 years. And unfortunately for us, the reasoning behind this occurrence is still very much uncertain today. Whether it be an inverting yield curve, rising interest rates, tensions with China and Europe, the oil crisis, or whatever it may be, we can't exactly pinpoint one catalyst that is resulting in this divergence in the markets. Instead, the best we can do as investors is look at this data head-on and understand how markets have historically performed during such tumultuous times. And surprise, surprise, there is some good data that shows us that stocks will historically perform much better over the next 12 months than they have over the past 12 months. And the very first reason has all to do with the way the top 5 stocks in the market have been performing. As you can see, even though right now they are giving us outsized returns, over the past 2 years, they've actually performed at one of the worst rates they have in the past 30 years. And as a result, the rally we are witnessing today is simply a relaxation from the second standard deviation returns we saw last time. What this means is that extremely narrow breadth, like we're seeing right now, can often be a sign of underlying strength in the market. Because if you look at the previous times we saw this kind of retracement in 2002 and in 2008 and 2009, markets performed extremely well, particularly small caps. The data shows us that whenever the top 5 index is outperforming the broader index by as much as it is today, it typically leads to marked outperformance in the markets over the following 3, 6, and 12 months. And neither have we seen something like the Kopog buy signal ever trigger before a recession, which means chances are the recession we're going to witness over the next 12 months is not going to be that on paper. Because, as we just found out very recently, the Eurozone just entered an official recession in the first quarter of 2023 with 2 consecutive declines in GDP. Meanwhile, in the US, we already witnessed this decline at the start of 2022, but the US government had other plans on how it wanted to define such a recession. And because we've already seen a lot of major collapses and capitulations from banks like Silvergate, Silicon Valley, and obviously FTX earlier this year, there's a very high likelihood that the recession is not going to print on paper for the United States. Because as we've seen from non-farm payrolls, jobless claims, the ISM manufacturing index, the underlying economy is simply way too strong. And unless we see a deep recession like we saw in 2008, it is not going to be registered by the media any one bit. Instead, all we're going to witness is what we're witnessing right now, which is simply an economic correction, where we're seeing layoffs in some of the hottest sectors like tech and industries, and as a result, people predicting a recession coming for broader markets. And since markets are obviously forward-looking indicators, this could most likely mean that the current bull market will stay intact despite any economic slowdowns we might see in 2024. And although it may take some time, even small and mid caps will start to catch up to the outperformance of the top 5 sooner rather than later. But as usual, folks, that is just my thoughts on the situation. What do you guys think? Is this bull market gonna last, or is this just another bear market rally in the S&P 500? Let me know your thoughts down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.